So now we begin with sales variances. Like before, we did like variable cost variances, fixed cost variances, and we knew that variances could be, divided into subcategories. So sales variances, they are also divided into two subcategory. So your sales variance could be sales price variance or it could be sales volume variance. Now, first of all, you understand that what is your total sales variance. So we call it sales variance or total sales variance. This is the difference between your budgeted sales and your actual sales. So imagine that your budgeted sales are 5 million. So you thought that you should be making $5 million in revenue, in sales. This is what you budgeted. And but then your actual sales, they turn out to be 4 million. So you made $1 million sales less. So your sales revenue, your turnover is actually $1 million less than what you actually planned for. Now, that's a very big variance, actually. I just put up this number. Now, this $1 million, of course, this is your unfavorable variance. And the question which comes to your mind that why this sales volume is less than expected, why the actual sales volume is less than the budgeted. So it could be possibly for two reasons. One is the price variance, and second is the volume variance, the price variance and the volume variance. The price variance means that your sales variance is less, possibly because you maybe were selling goods at a lower price because your standard price was 110 and then you were selling it for 100, not $100, but rather at $90. Or maybe you are offering bigger discounts. So sales price variance occurs when you sell goods at a price which is less than the budgeted price. And the second is that no, I was not selling lower price. I was selling it at the standard price of 100, but actually I thought that I would sell for 50,000 units, but I could only sell 40,000 units. I sold less units. So that means volume variance. And actually, the true name for volume variance is not volume variance. It should be sales volume contribution margin variance or sales volume profit margin variance. I will explain you the difference. So to begin with, we know that sales variance is divided between price and volume. Price means that I did not achieve my sales target because I sold at a low price, or I could not achieve my target because I sold less number of units, which is volume. Okay. So this is, we say that sales price variance, did each unit sell for more or less than the budgeted selling price? And volume variance is about the quantity. Did the organization sell more or less units than it budgeted? So the selling price variance is a measure of the effect on expected profit of a different selling price to standard selling price. It is calculated as the difference between what the sales revenue should have been for the actual quantity sold and what it was. So I'll just give you an example that initially what your budget was. You thought that you would sell 10,000 units at $10 each. Okay, at $10 each. So this is actually 10. Now, when you come up to your actual sales, what happened that your actual sales are 12,000 units, which means you are selling more, but at $9. So 12 times 9 is 108,000. This actually was 100,000. So you thought that you should be making $100,000 sales by selling 10,000 units. In reality, you sold 12,000 units at $9, which is 108,000. Apparently, you would be happy. You are happy that my sales are more than my budgeted thing. But actually, if you talk about sales price variance, the price variance says that your actual quantity is 12,000 and your standard price was $10. So you should have been making $120,000 by selling 12,000 units. This is should have been. But 12,000 units were actually sold for only 108,000. So if I talk about my sales variance, my sales price variance, it is $12,000 adverse. So although your total sales revenue is more, it is 8,000 more. Like 100,000, I thought it came out to be 108. But before I become happy, I should see that how much my 12,000 units should have been sold for. So my standard price was 10. So at the present price of 10, it should have been sold for 120,000, whereas I am actually selling it at 9 and I just made 108. So it means that $12,000 is my sales price variance. We call it price variance. Okay. So price variance is the difference between the actual price and the standard price multiplied by the actual number of units. Volume variance is a different thing. Volume variance is about the number of units which you are selling more or less. For example, you said I was about to sell 10,000 units. My actual plan was to sell 10,000 units and I sold 12,000 units. So it means that I sell 2,000 units more. So if you are selling units more, that is actually a favorable thing, which means that it's a good sign. You should have, you know, sold 10, you are selling 12. So 2,000 units is a favorable thing. But then again, remember that variances are never expressed in terms of kilograms, in terms of units, and so on. All the variances must be converted to number. So which number should I multiply this 2,000 units with? I have to convert it into dollar value. Now here the difference comes. So should I be multiplying it with $10, which was my selling price? The answer is no. You do not multiply it with the selling price. You multiply it with the profit margin. Now, if you remember, we have absorption costing system and we have margin costing system. In absorption costing, we calculate profit. And in marginal costing thing, we calculate contribution. Contribution was selling price minus all variable cost. Contribution is usually a bigger number. Maybe your profit was $2, maybe your contribution was $3. So don't multiply it with 10. 10 minus the variable cost and the fixed cost gives you profit. 10 minus the variable cost gives you the contribution. So I have to, so when I sit down and I say, okay, I've got $2,000, 2,000 units, I sold more. So that's a favorable thing. With which number should I multiply it? So I see which accounting system are you following? You say, we follow marginal costing system. If you follow marginal costing system, I should multiply it with contribution. And I call it sales volume contribution margin variance. Sales volume contribution margin variance. On the other hand, if you say, no, we don't use marginal costing, we use absorption costing. So in absorption costing, you don't have contribution. You talk about profit. So I say, okay, let's multiply it with $2 then. And now I call it sales volume profit margin variance. So sales volume variance is not the complete name. It must be sales volume contribution margin variance or sales volume profit margin variance. So first I calculate the volume variance itself, and then I multiply it either with profit or with contribution, depending on if I'm using contribution marginal costing system or if I use the absorption costing system. And then we see, in other words, it measures the increase or decrease in standard profit as a result of the sales volume being higher or lower. Yeah, I mean, the purpose is to find out the change in profit and the change in profit due to a change in the units sold. So here you get the formulas calculation, line by line approach gives. You can calculate, the price variance as actual quantity into sold, actual quantity sold into actual price, actual quantity sold into standard price. This is the formula. You can call it that actual price minus standard price multiplied by actual quantity. It will give you the same number because actual quantity is common. So I take it common as outside mathematically. So if your actual price was 10 and your if your actual price was 9 and your standard price was 10, And then you say, how much is actual quantity? Actual quantity was 12,000 units. So you get $12,000 because standard price was more, actual was less. So it is $12,000 adverse variance. This is for price. For volume variance, actual quantity sold into standard margin, budgeted quantity into standard margin. So standard margin was your either the contribution margin or the profit margin. So it is the difference between actual quantity and the budgeted quantity. So my actual quantity was 12,000 units. My budgeted quantity was 10,000 units. I thought I would be selling 10,000. I did sell 12,000. So I sold 2,000 units more and I multiply it with my margin. Which margin? Either the contribution margin or the profit margin, depending on which accounting system I am following. Okay. So these are the formulas. You can do it with logic actually. What are the possible causes of sales variances, which means that why your actual sales are not equal to your budgeted sales? Unplanned price increases, sometimes price goes up, so it means that you might be favorable, but when you increase the price, your volume goes down. Okay, so remember that it is not always possible that I increase the price and then volume remains same. So if my price variance becomes favorable because I'm increasing the price, it is possible or probable that my volume variance goes down because I will be selling less number of units at a higher price. Unplanned price reduction, maybe you give discount. Unexpected fall in demand due to recession, maybe market goes down, so volume goes down, or increased demand due to reduced prices and so on. These are the different possible reasons. These are not the only reasons. There could be many others as well, but these are the most common reason. Failure to satisfy demand due to production difficulties. So it means that demand was there, but you could not produce and you could not sell the goods. I mean, you could not just meet the demand because of your shortages in the production process. So these are, I mean, this is rather simple actually. Sales volume, sales variances are not difficult. Price variance is straightforward. Just take the actual price and standard price, multiply with actual quantity, straightforward. For volume variance, find out the difference in the number of units which you planned and which you sold, and then multiply it with either profit or contribution. So you have to calculate profit sometimes or contribution, which you multiply with the volume. So this is sales volume variances, sales price variances.